Hey everybody, Colin Plume, CEO of Noble Gold Investments, and wanted to go live today because the Fed's having its meeting. I got Micah Haynes on, one of our top salespeople here at Noble Gold Investments, and also a great analyst. And I know we've been excited about this meeting, and we're going to cut to it right now about what's happening and why they're cutting rates and how much. And yeah, what's up, Micah? How you doing?
Super good. Yeah, it's Fedness Day. It's the Fed and Wednesday and Fed Day, so it's
Fed
Fedness Day.
Day together, Hump Fed Day together.
Yeah,
Um,
nothing earth-shattering apparently, but we always want to hear what's being said. So
yeah,
as soon as he's on, it's really nice to just hear it from the horse's mouth. Now, I feel like we've never cared so much at any other time in history about every single word that comes out of the
sure.
Fed chair's mouth. Every
Right.
reporter, every analyst, every hedge fund firm, they're all like trying to decode what he says. I try to take him as literally as possible. And Powell's a pretty straight shooter, so we'll just have to see what he says.
Yeah. Are we on or what? Let's see what the guys. Nothing's up. Is this the Fed? This is the what? But I thought it was at 11:30. Shouldn't they be?
So if you go to the press conference, he generally comes on.
U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards two essential mandates set by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions.
Let's see what's going on here.
Okay, he is live now. I've got the link here.
Okay.
I'm just going to send it to JR.
Okay. Or send it to Fernando if you can.
Okay, yeah.
Let's see what the metals are doing. Silver's down 67 cents. Gold's down 630.
Yeah. Yeah, so actually silver's it was down about this much this morning, and then it recovered a bunch.
Okay, we're gonna jump on. Let him.
Okay.
Powell, get in here. Give us a second here, everybody. Powell, where are you? There we go. Okay.
From its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal.
Yeah,
estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Myron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, you and other Fed officials have spoken extensively about the impact
Please shut
of
that
tariffs
down.
on
Yeah.
inflation. Although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timoroso, the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
That's a good question.
Yeah, I think you could think of this in a way as a risk management cut because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
So just looking at the SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates.
Not the only one.
Of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address.
Right.
How do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply. And we know that because the unemployment rate has ticked up. So, that's what I meant by that.
If I could follow up, every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later.
Very
2%
good.
does not seem to be in sight. Does that suggest
keep
that
pushing the target
2%
out. That's the
target
key.
is not
Well, they'll
really
never get back to
achievable?
2. That's my
And does this
opinion. They just
present any credibility problems
What do you
for
say,
you
2028?
in telling people that that's what you're going to do if
28.
you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's literally how you put the projections together. You're writing down a rate path.
That's
which
how
is
you keep your
designed
job.
to create
Yeah.
over the course of
There's
the
no
S&P,
doubt he's going to lose it
time
anyway.
frame.
It
Well,
doesn't
in
matter.
May,
2%
exactly, and
inflation
we'll
and
talk
maximum
about that.
employment, too. So that's
maybe
that's all that is. No
Kind
one
of
really
big.
knows where the economy will be in 3 years. But the nature of the exercise is to
It's a model.
write down policy that you believe
It's a
would
model
return
that
to the
shows
2%
that
goal
they
over
can
the
get
over
down.
at least by the end of the
What I don't understand
exercise.
is this thing about immigration and unemployment.
Thanks so much, Elizabeth Schulze with ABC
Yeah,
News.
Shouldn't the unemployment
was
The
all
go
latest
illegal
down?
report shows
immigration
that
anyway,
prices
right?
are still going up
you
across
say?
key categories.
It was
for many
mostly illegal
households, including
immigration.
groceries.
That's what I'm
What
saying.
will the
If-
Fed
if-
do if
How are they
prices
actual
pick up more?
employees? Aren't those all under the table jobs?
Our
That's what I don't
expectation,
understand,
and
yeah.
you can see this
Yeah, it's a really
consistently
good
through the
question.
year, has
Shouldn't
been that
unemployment be going
inflation
down?
will move up this year, but that
Because
the
shouldn't those jobs be
basically because
replaced
of
by
the
people that
effects
actually
on
are
goods
Actually,
prices from
citizens, yeah.
right?
but
That's
that
yeah.
those
I
will
agree with
turn
you.
out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much every all the individual
Basically
forecasts
alluded
say
that he's going to drop rates
We
pretty
can't
much
just
every
assume
meeting.
that, though, right?
quarter
We have
point
to.
for
Between
a
Our
year.
year.
job is
Year.
literally to
Yeah.
make sure that is what happens,
And-
and we will do that job.
They're going to get down
Right
to
now,
3%
the
Fed funds
situation
rate.
we're in is that we see
think right now it's
inflation. We
4.5,
continue to
yeah.
expect it to move up, maybe not as high as we would have
Got a few
expected it
notes
to
here
move
so
up
we can dissect
a
some
few
of
months
this.
ago.
Yeah, I think we can cut
The
out. I think we got
pass
what we
through
wanted here.
into
Okay.
of the tariffs into inflation
Yeah,
has
he
been
probably
slower
won't
and smaller.
say anything
The
new at
labor
this
market.
point. It just kind of go in circles. So, Colin, go ahead with a few things that you want to note there. I've got a few.
Yeah, I was just going to say that he basically thinks we're going to get back to 2% inflation by 2028.
And getting called out for having the same plan like
Every
2 years
time,
and 3 years
right? Always
ago.
2 years out.
Exactly. Yeah.
Yeah, that that's we'll see. I mean, I understand. I do modeling for my businesses too.
Yeah.
You model out a likely scenario of if you do this, this will happen. I don't know how the 2%. If earlier this year he was saying tariffs were a driver of inflation, and he knows the tariffs aren't going anywhere.
Yeah.
And he knows they're not going to go anywhere for this presidency, at least.
Yeah.
So what information does he have? Is he changing his tune that actually the inflation we have right now is not caused by tariffs? He does talk about also that the tariffs on the goods is like minuscule. I think he said it's a small amount and it doesn't really affect the bigger picture.
Right.
Which
Yeah.
is really much different than what he said earlier in the year. The reason that he was saying that inflation was going up was because of tariffs.
Right.
So he's changed in this
And
meeting.
I think a lot of that's political. It's like he's probably been told to mellow out on any kind of like anti-tariff rhetoric or policy statements. I think it's interesting though that he knows that we actually have like deflation in services, but inflation or like price increases in the cost of goods. And that's notable to me because like the cost of performing a service is going down because there's less demand, meaning there's less spending. It's like whether it's a car wash
Right.
or a car detailer that comes to your house or, a landscaper, it's like a physical service. If the price of services are going down, it's because there's less demand for it.
Correct.
If the cost of services are going up, it's more of a hard type of product, which means it's harder to get. It's more expensive to get into the country, which is probably more tariff related than not. So I think that's interesting to note.
Yeah. Also, I was going to jump in just a thought to what you're saying is I have a friend that works an attorney for a lot of the top restaurants in the country. And we went and I got to pick the brain of the owner, who's the chef, James Beard winner, for an hour about the business and everything. It was fascinating. The food was great too, but like, for me, that was probably more interesting. And he said, Sharon, my wife asked, what about food costs? This was, by the way, this is like 3 weeks ago. Like, are food costs going up? He's like, actually, food costs are going down.
Oh, interesting.
He said food costs are down by like 20%.
Wow. So their margins kind of getting better, just keeping prices the same, but the cost of food.
Yeah. He said it's the first time it's happened in a few years, but he said that the costs have actually gone down. So, and a lot of it is like when people see costs of things going, it's a lot of it is just corporations.
Yeah.
They just see a headline and they just raise prices. It doesn't always translate into what is actually happening for them per se. So anyways, to go along with what you're saying, like there's
no, that's awesome. I think one of the other important things that he said that struck me is like he's like, oh well, the revisions of the job numbers, because so what happens is like they post JOLTS and non-farm payrolls and all the job data that comes out every month, but the Bureau of Labor Statistics does like kind of a retroactive analysis and revision ad hoc, like kind of almost like a postmortem. So after the data comes out, they do an actual revision, and it's usually months after the fact. It's 2 and 3 months behind. He's like highlighting the fact that the jobs numbers all through the summer or since the spring, they've all been retroactively revised down, meaning the actual number of jobs that we say are being added every month is a lot less than what's actually happening. That has been going on for years. It's not just the last few months. It's like the BLS consistently revises jobs numbers down. It's like almost the norm. So it's funny that he's using, in my opinion, that now as like one of the reasons to be concerned about the economy. There has to be some other kind of bell flashing, like, or ringing, or some light flashing that's kind of getting him concerned. But that was interesting to note. Also interesting about the employment piece. So demand for employment's going down. We've seen a lot of headlines about layoffs.
Sure.
A lot of that's in tech. So we're seeing a ton of tech layoffs. But the type of employment supply that he's suggesting has also gone down a lot because of immigration policy. I'm scratching my head like you raised about like, how does that even make sense? Because all the illegal immigrants, they're, pardon me, but they're probably working like landscaping jobs, or they're bussing tables, they're doing something for cash as illegal immigrants. They're not actually getting real employment. So I wonder how that's actually affecting real employment numbers to the extent that it's now a concern from the Fed. Seems a little fishy.
That didn't align also, but I guess big picture, quarter rate drop today. I looked up the 30-year mortgage is the lowest it's been in 3 years.
That's great.
6.13%.
Yeah.
And he said he's going to try to get the federal funds rate down to like the low threes.
Yeah. So right now we're 4.5, I think. As of today, the quarter basis point gets us to 4.5.
4.5. Oh, okay. I thought they were trying to get to 4.25 or less.
I'm pretty sure today's quarter basis point
might be a little
brings us to 4.5.
Okay.
I'm pretty certain of that.
Yeah, and then no, they want to get to 4 to 4.25. That's what they're saying. That's what they voted on today.
Okay.
Well, maybe it didn't hit it today, but that's what they're trying to get it to.
Right, and they
react tomorrow.
They've got the next 2 meetings to try and do that as well.
Yeah.
Okay.
Yeah. And then gold held firm at 3,700.
Yep. It had dropped a little bit. Actually, now we're down a full percent. So if we're just looking at,
oh really?
I'm using goldprice.org. Happens to be kind of my favorite noise-free, just spot price metric. I don't know if that's futures. I think that is futures. That's why there's a difference there. So just in terms of spot, we're down $41. Silver. Okay, this is what's interesting. You know what they say about Fed meeting day, Colin, is never trust the first move. So like if the metals rally out of the meeting or they rally in the morning, like that could very well change by later in the day. I wouldn't put a lot of weight in that, but like silver started the day 1.8% down. And then it was all the way up to only about 1% down. Now we're like three and a bit. And if you don't mind, can I just riff on this a little bit about what I think is happening? It's going to be super short-lived. You know, well, from a lot of the stuff I've shared on here through the summer, that like I think retracements are actually super healthy for the sustained movement higher in precious metals prices. So I think it's actually good that they're letting off a little bit of steam. We have to think like the last few weeks for silver especially has been like very good. We've gone from like 37 to 42 and a half, like almost 43. We've added $5 in like a month, you know, give or take. And actually what started that and what fueled that move, where gold had broken out and silver was also moving really quickly out of an area couldn't get above, was the policy stance and the announcement at Jackson Hole that they were going to be cutting and being more accommodative. And, you know, essentially they're going to start easing and cutting rates. When that was announced, the metals moved, because before that's all new, right? That's all brand new news. The cut itself is actually already priced in as of the last few weeks, right? That's why they've been moving higher. So now you actually have the Fed deliver exactly what they expected. And with what I take away from that speech, it's like he's coming out, he's not dovish, he's not hawkish, it's super neutral. It's a total like nothing burger cut. There's nothing extra for markets to get excited about.
Right.
And with the dollar losing so much, just even in the last few weeks, as that policy stance flip occurred, it's kind of like every gold bug and every dollar bear is expecting just a little bit more from the Fed today. But it's like, man, he gave you exactly what the markets expected. There's nothing new. And now people are like, oh, geez, the dollar's now probably going to rally for a week or two.
Right.
So I would see that as probably what happens over the next couple weeks. I could be wrong, but we could go into the end of Q3 with the metals letting out a little bit of steam.
Yeah. Home refinance applications highest in 3 years also. So people are going to take advantage. They see the rates dropping. They were to give it any indication, we were at 7, even higher at 1 point, 6.13. It looks like there could be 2 more rate cuts projected this year. And so we could get down. So I think we're going to get below 6 in terms of 30-year, and that's going to be great news for real estate. I think it'll help a lot.
I hope so. Just remember this time last year, and they cut by 50 basis points. They actually kind of surprised the market with a big fat first cut to start off, and longer term yield and the dollar actually started shooting up because they figured that was so inflationary. I think that's also why we're having such a tempered cut today with there not being any surprises, is because they're actually not wanting to spook the bond market. So I agree with you. Like if again, this is like kind of coming along as expected, then you're not going to shock long-term yields. They actually should come down kind of around the same time. And the inflation side, it's not really getting any extra juice with this cut today. Again, everyone's already expected this. So I think that's good. One of my bigger concerns though is like we're having kind of the two sides of their mandate. And like you'll note, he always comes back to that, like our dual mandate of maximum employment and stable prices. Like I think we are seeing him losing control of like both of those things. So you've heard me before say, like, I think stagflation is the most likely outcome. I kind of view like the Fed, and he even said this just a few minutes ago, which was like, you know, we've had these fast swings in either direction. So we cut like crazy during COVID, we hiked like crazy afterward. And it's almost like, you know, you ever use like an old shower? You crank it to full heat because it's super cold and nothing until all of a sudden like boom,
Yeah.
you're scalded. And then you're like, geez, I got to go all the way back. And you go all the way to cold, but it's still scalding until all of a sudden it's like ice water. And so they've
Right.
just been ratcheting like all one way, all the other. Now he feels like they're kind of in the middle, and it's kind of a bit of like the perfect temperature, except you have now employment dropping and inflation rising. So like they'll never get to 2. We're actually at 3. The guideline of always trying to say that we are going to get back to 2, it's like they're going to say they're trying to get it, close to 2 or whatever it is. They're never going to get, I don't think, back below 3. And with us seeing these recessionary signals of job losses and unemployment going up, it's like the worst of both worlds. They could actually see tons of job losses through a recession and an economic contraction. And whether it's tariffs or not, or a bunch of other factors, or just low rates themselves, like inflation running off again is like the worst thing they could possibly have. It's like them failing at both of their 2 dual mandate goals.
Right.
And I predict that's probably where things go, like is stagflation, which is like going to be the biggest reason for people to call for the end of the Fed, which of course, like a lot of gold bugs jokingly do believe, or not jokingly, they do believe in that. And a lot of people jokingly do say that. But I think legitimately within a few years, we actually have a concrete reason for the Fed to be scrapped if those 2 dual mandate pieces fly off, if it gets totally out of control.
Sure.
Which is again what I think happens. Sorry to keep running on there. But that's just where I'm coming from.
No, I think you're right. I don't think there's a plan to get there, even though he says there's a plan by 2028 to get to 2% inflation.
Right.
I think it's unlikely. Micah, thank you. Interesting meeting. Hope everyone enjoyed it. You want to learn about gold and silver. Obviously, the thing that comes out of this is that they're going to weaken the dollar. Precious metals are going to do well long term.
Yep.
Call Micah. He can help you. Get you into metals and protect you.
And use this dip. If I'm right about the next couple of weeks, use this dip. We won't have too many others going into the end of the year. I actually think so we might see high 30s, something like 3,300 again in gold. But from there, we probably see 4,000 in gold and that crack of 50, a new nominal high in silver. So use the dip. Get in touch. Thanks so much, Colin.
Absolutely. Thank you guys. Thank you, everyone.